Okay, on that note, let's shift focus and talk about Ashok Leyland in terms of their earnings. We're going to be joined by the management very soon on the show. And before we do that, just taking you through what some of the numbers are looking like on a standalone basis. The revenue is up 10.5%. The net profit is also seen an uptick of 2.5%. The EBITDA continues to be flat at 970 crore rupees, while on the EBITDA margin front, we've seen slight compression this time around to 10.1% compared to 11.1%. All in all, it's a decent set of numbers coming in because the revenue and the bottom line are in line with what the street was estimating, with a slight beat coming in on the EBITDA. Let's take that conversation ahead with Mr. Shenu Agarwal, the MD and CEO of Ashok Leyland. Mr. Agarwal, hi, good morning. Thanks for joining us. Congratulations on the good first quarter. Your EBITDA margins have come in at 10.1%, beating estimates. How much of this was product mix and opportunity-based inventory, and how do you see the margins going forward?
We are happy with the numbers. I mean, we know that there has been a lot of headwinds across the automotive industry in India on account of commodity prices. And that has hit everyone, and that hit us as well. But we had in good time, actually anticipating that this is about to come, we had taken several initiatives. I mean, first initiative was on the pricing side, where we were able to increase some prices in Q1 on both the MHCV and LCV side. Then a couple of quarters ago, we also started a internal project called Achieve 2K, where we are looking at all our material costs once again, and to see how much we can further optimize. So some of the benefits from that project are coming in now. Also, we had some advantage of the low-cost inventory that we had at the beginning of the quarter. So that also helped. And then even on our fixed cost, we were able to kind of squeeze that or cut the waste wherever possible. So I think we have weathered this quite well, and that is why possibly our performance is better than what Street had estimated.
Right, Mr. Agarwal. Also tell us about the material costs which have been rising. That continues to remain a key concern. What quantum of price hike are you targeting from customers in the remainder of the year FY27? And how is demand also responding on that front?
On the demand side, we are very hopeful that at least this quarter, the second quarter of the year, would be very, very strong. In Q3 and Q4, as you would recall from last year, the industry had started growing in around October or November, right? So we are sitting on a high base. But even if I take a conservative estimate, of a small growth in Q3 and Q4, we still think that overall for the year, we would land up in a good situation as far as industry is concerned. Now, coming to the commodity price, I do agree that the challenge will continue, at least in Q2. However, we do expect that Q3 might see some amount of softening. And Q4, I think the situation should start turning around. And therefore, as far as commodity prices are concerned, we do believe it's a temporary phenomenon. We should get some respite, small respite in Q3 and a larger one in Q4. And until then, we will continue to use these levers of product mix, of the business mix, of price realization, etc. Now, last part would be that whether we have seen any impact of price increases we have taken on the demand. So I think the answer there is no. And the reason for that is that there is a fundamental strength in the CV industry right now. We have been talking about aging of the fleets since last year, and we all know that aging of the fleet in India has crossed 10 years now, and historically it used to be 7.5 years. And therefore that fundamental acceptance or that strength is there in the CV industry. And that is why even with some incremental price increases we are able to get, it is not denting the demand.
Understood. So that's the take coming in on the pricing front. Mr. Agarwal, also trying to understand, the board has approved 325 crore rupee investment in Optare PLC and 500 crore in Hinduja Housing Finance. What is the rationale? Just trying to understand, for this capital going into your housing finance segment rather than your core CV business.
Yes, we have announced two different investments in our subsidiaries. One is on the Optare side. And this should not be a surprise because we were very open in telling that Optare had or Optare or Switch UK had about 80 million GBP of debt in its balance sheet when we restructured the company last year by stopping the operations in UK, and that debt has to be repaid. Last year, you would recall that we had paid about 30 million out of this, and now we are going to pay another 25 million. The point is that we do not have to repay it because we have longer tenure on this. But since we are sitting on very healthy cash and we have generated much more cash in Q1 also, so we thought it is better stop paying interest on that debt, and rather than paying interest, just liquidate that debt to the extent possible. Now, after this, there would be another 25 million of GBP that would be remaining that we will consider going forward. So that is on the Optare side. So it's not a surprise. It was known that this debt had to be repaid. The other investment that we have announced today after the approval of the board is an investment of 500 crores in our subsidiary called Hinduja Housing Finance. Now, we all know that this company has been growing very fast. This has already become the fourth largest affordable housing finance company in the country. The average CAGR of the last 3 or 4 years have been upwards of 30%. And we do believe that this company will continue to grow the way housing sector will emerge in this country and the need for affordable housing. And therefore, we thought that this is a good time to invest in this company, because we have very high hopes from returns from this investment in the future.
Okay. Understood, Mr. Agarwal. But also talk to us about Switch Mobility. That segment is gaining a lot of traction in international markets. Can you tell us what does the revenue run rate look like today, and when does that part stop being a cash drain for the overall parent entity?
Listen, when you talk about Switch, you have to look at Switch in two different parts. One is Switch India. And we have always been saying this in the past as well, that our target was to make Switch India EBITDA positive first, and then to make PAT positive. Now, EBITDA positive happened in FY25, and Switch is PAT positive in FY26 now. So therefore, as far as the India business of Switch is concerned, which is actually the highest growing business also, and in future also the growth prospects are very strong. So that company is very much cash sufficient. Here or there, some cash might be required, but that amount will not be very significant. So that is a good story. The Switch UK story, which we had already explained to you previously, that we wanted to shut the operations there because it was not viable and it was a loss-making business in UK. That business, that operations we had shut down last year. However, there was a 80 million of debt, like I explained, which had to be repaid. So essentially, I would say that other than that debt we had in Switch UK, there is no need for any major cash injunctions in Switch businesses.
Understood. That's on the Switch business front. Shifting focus then, Mr. Agarwal, let's talk about defense and power solutions. That segment has contributed strongly this quarter. What is the order book within each segment? And can these businesses collectively cross 10% of consolidated revenue in FY27? Would that be a fair estimate?
Yes, defense is actually something which is growing very well for us. Even in Q1, you have seen significant growth in our YOY defense business revenue. And this is something that we do believe has a very high headroom for us to grow even in future. Now, if you look just at our order pipeline, this order pipeline is actually getting stronger year by year. We have now orders in excess of actually 2,000 crores when we look at the overall defense business at AL cluster level. But yes, I mean, we are very hopeful to have significant growth in this business. Also on the power solution business, I think the story is similar because last year we sold about 36,000 engines there. We do think that we can sell much more than this. And we are taking those actions just to exploit that headroom that we have both in defense and in power solutions.
Got that, Mr. Agarwal. Thank you so much for taking the time and speaking to us here on ET Now. It's a pleasure to have you on the show. With that, we'll slip into a very short break, but don't go anywhere. We've got another management conversation lined up. Dr. Agarwal's group is going to be speaking to us on their first quarter numbers, so stay tuned for that right after this very short break.